Hello, finance students. Today we are going to cover chapter 20, and there is a PowerPoint here. And as you all might have noticed, when you click on the PowerPoint here and you try to look at it, it doesn't look, clear. In order to see the PowerPoints, you have to download it. You click here and you click download, and then it will be right here in the download folder, and you can open it, and here are the outcomes of this chapter, and these are the outcomes that we are covering in this chapter. One thing I will ask you to do is to copy this later into ChatGPT and whatever tools you want, and collect information about these things and post it on the discussion board, but you have to analyze it. I will show you in another video I'm going to send you. But for now, I want you to know that what we are covering in this chapter, and it is in this chapter, we are talking about fixed and variable costs and the impact of financial leverage. Let's think about what financial leverage is. Imagine that you want to open a restaurant. You have two options, and the restaurant costing $100,000, or let's say $200,000. You have $100,000 of money yourself. You need another $100,000. How can you get that money? One way is to go to the bank and say, give me 100,000. Another way is to go to a rich doctor and say, doctor, I want to open a restaurant, and do you want to be my partner? Do you see, these are two different scenarios. Once we talked about it. In the case of going to bank, you are borrowing. That means it is called debt financing. In the case of going to the doctor and asking the doctor to become your partner, become half owner, then in that case it is called equity financing, which means you are giving half of ownership of half of the restaurant to the doctor, and you own half of it. But in the case of bank, when you borrow money, the bank doesn't owe half of your business. You own all of the business, but you owe $100,000 of it. Each one of these has its own advantage and its own disadvantage. What is the let's start with disadvantage. Imagine that during the first year you don't have any customers. Let's say you have very few customers. The problem with debt financing is that every year you have to pay $20,000 to the bank. If you do not make that money, the bank can come and foreclose and close your business and sell the equipment of your restaurant. You go bankrupt. However, if you bring the doctor as one of the partners, in that case, you have not borrowed $20,000, $100,000 in the bank. You go to the doctor and say, doctor, we didn't make any money this year. You are a partner. You are the owner. The doctor says, okay, you don't need to give me anything. I am just like you. I am a partner, and I want the company to be successful. You didn't make money, but no problem. Of course, let's hope you have made enough for the rent and other things. But at least you don't have any expenses regarding your financing, because the doctor doesn't want any, payment from you as the bank wants you to pay. Therefore, that is the disadvantage. But what is the advantage of you? In what case you go and borrow from the money? You borrow from the money $100,000. Imagine that in the first year, I give you an extreme example. In the first year, you borrowed money, and suddenly you make $1 million in the first year. If you make $1 million, if the doctor was the owner, you have to give that doctor half a profit. $500,000 goes to the doctor, and you keep $500,000. In that case, you would have said, oh my God, I wish I had not brought the doctor as a partner. I wish I could had gone to the bank and I would have borrowed only 100,000. That way, when I make $1 million in 1 year, I would have paid $100,000 to the bank and I would have pocketed $900,000. Therefore, there are advantages and disadvantages when you borrow money. Also, in the case of there are tax, issues as well. We will talk about it. But for now, I want you to get a sense of the impact of these things on your income, net income, and what can happen. Leverage means, borrowing, the impact. You already learned the impact of borrowing in terms of that particular income, and we will talk about them in more details. And having impact of borrowing based on a variable, what can happen when you have a lot of fixed costs and when you borrow compared to you have variable costs. We will talk to that about that. When you are a financial manager, you have to make those decisions. It's not as simple as just one restaurant. Yeah, they hire you, a company hires you, and you have to think about, should I go and sell stocks? When you sell stocks, that means you are bringing many doctors into the business. When you go and borrow, or you sell bonds, when you sell bonds of the company, that means in both cases you are raising money. But when you sell bonds, that means you are borrowing, similar to going to bank. Therefore, the corporations have, big major companies operate somewhat similar to the restaurants. Restaurants, we are talking about two owners, but in case of Amazon, my Dow Jones company, we have millions of owners. Who are the owners? They are shareholders. Who are the bankers? There are bondholders that gave money to, and of course, Amazon can go to banks as well, but banks can come and give, 10 billion, 20 billion. It's a little bit challenging for the banks suddenly to give that much of money, but Amazon can go and sell bonds, and then the banks will buy those bonds, individual investors, and therefore we will talk about them in terms of explain how use of leverage affects return on equity. We already talked about it. That was the case of doctor. And determine the cost of debt. Let's not forget, the cost of debt means that when you borrow, the cost is interest. The cost of debt is the interest you pay for the debt. Therefore, this chapter talks about all of this because it wants you to, become familiar. Sometimes it's good to go and borrow. Sometimes it's good to, not to borrow, bring partners just like the doctor. Now we go to the next chapter, next slide, and conduct debt and prefer the stocks. We talked about stocks, we talked about bonds. Preferred stocks are something between bonds and between common stocks, because you think about it that you have three ways of financing when you have a restaurant. You can go to the doctor and say, doctor, bring, $100,000. Or you tell the doctor, I need $100,000. You give me 50,000, and you go to a lawyer and say, you give me 50,000. The doctor in that case is another, shareholder, but the lawyer is giving you $50,000, and the lawyer is also an owner, but not exactly like the doctor, not exactly like the bank, It is some features between the doctor and between the bank. That means that the lawyer is giving you the money, but if you make $1 million, let's say if you made $1 million in the first case of you and doctor, you kept $500,000, doctor kept $500,000. But when you brought the doctor, you keep $500,000. You give $250,000 to the doctor, but the lawyer doesn't get the $250,000. How much the lawyer gets, you will sign a contract with the lawyer and tell, you give me your 50,000 because you remember you needed 100,000. The lawyer gave you 50,000. You sign a contract with the lawyer and say, then, your lawyer, I give you, suppose, 10% of the remaining of the money after, something, 10%, of the money that we are making, or say, of your money. That means the doctor or the lawyer will say, I gave you 50,000, 10% of it is 5,000, give me 5,000. Why did you bring the lawyer? Because when you wanted to bring the bank, maybe the bank originally told you it wanted, let's say, 20%. You felt that the lawyer might be a better deal for you because is asking for less money, but at the same time, the lawyer also is more like an owner as well, not just like bank. The bank was not the owner; it was just the creditor. But in this case, the lawyer, the doctor is a real owner like yourself, but the lawyer also is the owner. Anytime you want to distribute the money, first you have to make sure, when you get if your company goes bankrupt, for example, the bank is the first one that gets the money because that has priority, very important. They sell the equipment of the restaurant and they get the money. Then the next person who has to get the money is the lawyer. Why? Because the lawyer was not as greedy as the doctor to become your complete partner. Therefore, he came or she came and gave you the money, that $50,000. He was hoping to get some kind of dividends from you. And those dividends are given, those profits are given to the lawyer before you give any money to the doctor. First, the lawyer has to, therefore, the money of the lawyer is somehow safer in terms of the money of the doctor. Before any money goes to the doctor, it goes to the lawyer. Therefore, that's, the focus of this chapter is not necessarily on preferred stocks, but I just wanted to talk about this. I go to the next one. And use fixed factors, fixed costs, instead of variable costs. We talked in last chapter, we will go through this in more details. We come here and higher operating costs with FC means fixed cost. Companies that have fixed costs or have a lot of expenses. Do you know that a lawyer does not have as much fixed cost as, let's say, a doctor with a laboratory in his or her office? Why? Because if you look at a lawyer, the lawyer has an office, doesn't have a restaurant, has a lot of, McDonald's has a lot of fixed costs. Why? All those equipments, rent of the property. When you look at that restaurant and compare it to the office of a lawyer and an accountant, like a lawyer and an accountant do not have a lot of fixed costs, but a restaurant has a lot. Some of the companies, you have Dow Jones companies, I assigned you. Some of the companies you have a lot of fixed costs. Some have a lot of variable costs. Of course, they all have some variation, a combination of those. And you have the companies that have high fixed costs have higher operating leverage. That's correct. Which therefore and must achieve higher level of sales to break even. It is completely clear in a lawyer to get his or her rent, her cost, all he or she has to do, get a few clients, and get the money, and that pays for the rent. But for the McDonald's to break even or for the restaurant to break even, they have a lot of fixed costs. Why? All those equipments you see in McDonald's, maybe they are costing $500,000. They are called fixed costs. And McDonald's has to sell a lot of Big Macs until it covers every month, it covers the payments that is paying for that high rent. Lawyer doesn't have as much in Moorfield and other cities. Lawyer might have a small office somewhere, let's say it's a one, but the McDonald's has has to be in a very good location, therefore has a lot of rent, therefore it has to sell a lot of Big Mac until it reaches to its break-even point. But once McDonald's covers that break-even point, which means it is in a good shape. Now we go to the firms with costs fluctuate by the level of output. Many achieves, fluctuate. Many achieve pride at lower level of production. Therefore, we will talk about that in more detail as well. We go to this slide. And operating leverage means when you are borrowing by fixed turnover, you get, sales divided by fixed assets. Let's say McDonald's sells $1 million every year, and the fixed assets it has, the equipment, is $500,000. When you divide 1 million by $500,000, you get two, because 1 million divided by $500,000, that means two. Therefore, it is called asset turnover. Meaning of asset turnover is that the assets every year, the cost of assets are covered by sales twice. That means that the sales can cover two times the assets of a company. That means that $500,000. Therefore, low fixed asset indicates the firm uses financial investment in turnover and equipment, and which means if McDonald's uses $1 million for the assets and sells $1 million, you divide 1 million divided by 1 million is 1. Therefore, the number is low asset turnover. In that case, that means McDonald's has a lot of, equipment. But when you go to Burger King, for example, Burger King means sells 1 million, and then the assets are $500,000. 1 million divided by $500,000, you get 2. For McDonald's, you got 1. That means that they have very low fixed asset turnover, which means it had a lot of equipment. But in Burger King, the number was instead of 1 was 2, which means McDonald's is a kind of, is using a lot of assets, to generate sales, compared to a lawyer will have a, high number. The lawyer sells $1 million, gets $1 million of revenues in 1 year, and he or she has only 1,000 rent. If you divide 1 million by 1,000, a lawyer has an operating leverage of $1,000, which is great. That means that in 1 year, he can pay his rent 1,000 times over. Therefore, as a financial manager, you have to be careful about these numbers. I don't spend so much because there are too many, slides. I go to this one. And let me see if I can, this slider, makes it bigger. And I come here and look at, see what it is trying to say. And I make it a little bit bigger, and we come here, and maybe a little bit bigger as well, helps that for visibility. Then I come here, and let's see what this is. This is an example of McDonald's. Do you see at the top is written fixed costs? Fixed cost of the McDonald's, we said maybe it's rent and its equipment, has to pay $1,000. Variable cost for McDonald's is $1. That means every Big Mac it sells, cost at the cost of it has to buy materials. That's $1. Therefore, and then when it sells Big Mac, it sells the Big Mac to $2. Do you see here on the left column, everything is $2? That is what Big Mac's, how much it charges for Big Mac, $2 a Big Mac. Then quantity, if it sells a 0 Big Mac, the revenues, the first line is nothing. It doesn't have, it hasn't sold any Big Mac. But at the same time, it has a fixed cost of 1,000. It has to pay rent. It has to be, we are talking about the first line. Do you see on their fixed cost 1,000? And its variable cost, we know that if it sells any Big Mac, it is $1, but because it didn't sell any Big Mac, therefore it doesn't have any variable cost, which means it still has that fixed cost that it has to pay rent, it has to pay for the equipment. Therefore, on the right column, you see its profit and loss is negative 1,000. That's what it is losing in $1,000 this month if it doesn't sell any Big Mac. Imagine it doesn't have any employee. We are just giving an example. However, when it gets to the number, do you see on the profits, it gets to 0? That means that that's its break-even point. When does that happen? When that happens, when each Big Mac is $2,000, it sells $2,000, 1,000 of Big Mac, because it is $2 each. That's line 1, 2, 3, 4, 5, 6. it is the total revenue is $2,000. Out of that, $1,000 of it goes for the fixed asset, and $1,000 of it goes for variable cost because it sold 1,000 Big Mac. Therefore, each Big Mac is costing McDonald's 1,000. Therefore, out of 2,000, 1,000 goes for the rent and 1,000 goes for the cost of Big Mac. The McDonald's doesn't make any money when it sells 1,000. As it increases, therefore, now the next case at the bottom, look at here, I'll bring it a little bit. If you look at what will happen if the fixed cost of McDonald's becomes 1,500. Look at the green border line at the very bottom. It says fixed cost. I will bring it up. Here it is. If fixed costs become 1,500, now imagine that the rent has gone up, for example, it becomes 1,500. But McDonald's has done something very smart. Rather than going and buying its Big Mac, its chicken patties or anything, beef patties for $1, this time it is buying it for 70 cents. Therefore, it has reduced its variable cost, but its fixed cost has increased. Therefore, that has another scenario. And in that case, in this particular case, McDonald's, do you see here is written 20 cents at the bottom? That's almost break-even points. In that case, McDonald's has to pay $1,154 to break even. In previous scenario in here, it had to sell only 1,000, but in this case, it has to sell $1,154. The variable costs, didn't work in its advantage, but somewhat, the fixed cost, the variable costs helped McDonald's a little. But now McDonald's is a little facing challenge because it has to sell more Big Mac to break even. However, what will happen is that at the very end, when we look at it, we will see that McDonald's at the second scenario is worse off because when it sells 2,000 Big Mac, at the first scenario, when it, here it is. When you look at compare those two scenarios, the first one, which is on the top, it had to sell 2,500. One second, please. 1 second, I got a. Sure. I'm sorry, someone knocked on the door. And then if you look at here, you see that in this case, you have to compare them. The bottom line says that if McDonald's, sells to 2,250 Big Mac at the very bottom, it makes 1,425. But let's look at the very last line. In the case of this one, when it sells 2,500 Big Mac, it makes $1,750. In the previous case, if you look at here, it had to sell 2,500, and then it made only how much? It made 1,500. Therefore, this second scenario for McDonald's is better when the fixed costs are at 1,500 and variable costs are at 70 cents, because by selling 2,500 Big Mac, in the second scenario, it has made 1,750. Therefore, you as a financial manager have to watch fixed costs, variable costs, come up with different scenarios, use Excel to see what would be the impact on the company. Then I come here and I click here and I will let me make this one smaller. Here it is. Let's see what ratio of revenues to fixed assets. Let me make even a little smaller. And firms, here is an energy company. You all electric power company has a revenues of, think about, these are most likely in millions, but for now we talk about dollar. This has made $17 and its fixed assets are 99.3. Think about it as $100. If a company has $100 of fixed asset and this year it makes $17. Therefore, that means in 1 year it only gets 0.17, 17%. Or think about it as 20%. Think about the revenues as 20%. This is $100. That means $20 and $100 fixed asset, which means it takes 5 years for the company to sell, to get revenues to pay off its fixed asset, because fixed assets are 100, revenues are 20, 20 times 5 is 100. Therefore, that's a sales to fixed asset. That means that every year here 0.17, or think about 20%, that means that their sales only cover 20% of its assets every year. Let's look at Amazon. Amazon has fixed asset of 160, but it has revenues of $500, and this 500 is billion, 469 billion, but for simplicity we say 500. And this is a kind of little older book. Now the revenues of Amazon, it's a company I am researching, its revenues is almost getting close to maybe $1 trillion. That's a lot of money. That it's almost twice, it might be twice as this. Maybe the book is 2-3 years old, and that's why it is saying it is 469 is $500 billion. In 1 year, do you see here is written 293? That means if it gets all of its revenues, it can pay off all its fixed asset 3 times over. Of course, as you know, revenues are not profits, it's just its sales. Let's not forget not to mix up between revenues and profits, because when Amazon has those revenues, they don't go to the pocket of Amazon $1 trillion. All Amazon makes every year maybe $50 billion, $30 billion, $40 billion. The revenues are there. Therefore, Uber, do you see Uber is very interesting. Uber has a less fixed asset. You know why? Because, and you all know, because the cars that the people drive do not belong to Uber. They belong to the drivers. That's why Uber has only, 1.9, fixed asset. And revenues are, $20, is, or think about $17 billion of, revenues, and very little fixed assets, because, only Uber most likely has some buildings. Do you see that? Those are fixed assets, some computers. However, the cars don't belong to Uber. However, a car rental company might have a huge fixed assets. Why? Something like Enterprise, like Hertz. Why these companies have high, fixed assets? Because they own those, unless they lease them. But if they own those fixed assets, they buy the cars, which they buy because sometimes they sell. Therefore, Uber has a low fixed asset, and their sales to fixed assets are very high. However, in Enterprise Rent-A-Car or Hertz, sales to fixed asset might be very low because they had to buy their own cars. We come here and risk for individual firms. When you are borrowing, you are taking a risk. We gave this example in the case of doctor. Do you remember? We said that the doctor said that, when he or she borrows the restaurant, when the owner of the restaurant borrows money from the bank, takes a risk, because in the first year, if he or she doesn't have any sales, the bank can come and shut down the restaurant. Therefore, we have business risk. Business risk is there. You know what it means? Do you remember when Corona came and, the restaurants had to close? That's a business risk that we are taking. And of course, it's not specific to a restaurant. It was economic risk, and, and also it has financial risk. Financial risk is when he cannot pay its obligation, and increase the variability in operating income and increases business risk. We go to this one, operating leverage and risks for individual firm. We talked about this, in here. We go in here, industry level risk example. We know airlines have huge, because you own airplanes, you own, a lot of, therefore, retail doesn't have a large amount of operating leverage, few fixed costs, and many variable costs. think about somehow, imagine that you have opened a store in a mall to sell some t-shirts. Think about, you are a retailer, you don't have as much fixed costs, your rent possibly, but you have variable costs, a lot of shirts you have to sell. Therefore, those shirts, any shirt will cost you $1. You sell, Therefore, that's the way to look at this. And then we go to the next slide. And I want you to look at, this is an interesting chart I want to show you. And here is the retailer compared to airline. Do you see the airline? Before it gets this QB, the line in the green line in the middle, it says QB. Q means quantity on the horizontal bar. In the vertical line, we have a dollar sign, which means a Q2. That means, think about Q2 means that how many passengers an airline has to have until it's break even. It breaks even at QB. QB means break even, B even means break even point. Do you see, before the airline gets to its break even point, it has, the green line is the total revenue, TR at the top. The brown color is total cost. Do you see the total cost of an airline is high? That S is high. And do you see the total cost of airline is more like an horizontal line? You see that? It goes, almost up and up a little bit. And then between, do you see here E and F? Above Q2, it's written E and F. The distance between E and F is huge. That means before the airline gets to its break-even point, it is losing hugely. However, after this airline gets to the break-even point where it says BQ, do you see these two lines intersect? That's a break-even point. As soon as it gets to that point, this difference between the TC and TR, which is this AB, do you see how widely it goes? That means suddenly, as soon as it covers its fixed cost, which is high, it suddenly turns a profitability, and it is a huge profit. But in the case of retailer has a low fixed cost. You see, you are selling t-shirt, the chart below, and then your fixed cost is very low. You only have a rent. But an airline not only has a rent, has to pay for the aeroplanes. For you, at the beginning, do you see that if the Q two for the retailer, the difference between H and G is that if you don't go into your break-even point, you lose a little money. Do you know why? Because those poor airlines, they have, before they get to their, not only they have to pay for their rent, and they have to pay for the payment for the airplanes that they have paid. Therefore, they have a lot. That's why at the beginning they were losing a lot. But for you, at the beginning, you were not losing a lot, because all you had was the cost by Q2. You had so many customers buying t-shirt. But when you cover your break-even point, BQ, you see that they intersect the lines. But after that, you see your profit is the distance between D and C is smaller and shorter. Which one of them is better? It depends on how much profitability you are going to have. Therefore, these are something as financial manager, you have to make the decision. And I go to the next slide. And here it talks about, why business risk vary by industry. We know why it varies. We know that someone who sells t-shirts, t-shirt retail industry might not have as much, but a company like Hertz might have a lot. Because that is, they have a lot of cars, they have to keep buying. Maybe some companies, industry, let's say, although a lawyer is not manufacturing, but you understood that the risk to a lawyer in terms of paying for its fixed cost is very low. And then we come here, business by industry. And operating leverage. The meaning of operating leverage means that you borrow how much you want to leverage. The meaning of leverage is you use a tool to lift something big. Therefore, you use debt to lift something big to make a huge money. And then these are the issues that you have to consider: competition, variability of demand, input costs. You are a financial manager and you have to take all of these risks into consideration. And each industry has its own unique type of risk and economic risk. Assets might be financed either through debt or equity. We already told you that was the example of restaurant, that you wanted to own all of it or bring the doctor. If firms use a debt financing, it has financial leverage, man. It means that it is using money, a bank money, to lift a huge profit for itself. Of course, it takes a risk as well. And therefore, we come on to this one. And, when you are using financial leverage, then you will have more volatile income and you are carrying more risk. I told you, if you don't sell anything in the restaurant, the doctor wouldn't come to shut down the restaurant, just keeps, working with you, and therefore nothing. And then we want something to know about debt ratio, how much debt you are taking. What is this chart? These are between debt ratio and return on equity. Let's think about this one. This is an example of a company that has zero. Imagine you want to start your own restaurant. You have the option of, getting zero debt, or you imagine you need $100,000, or in that case, the debt, the zero debt means that you are not borrowing, you are bringing doctor, or you are using your own money. Think about, you are the only owner. You can get zero and your restaurant is 100,000. You don't borrow, just you use your 100,000 to buy a restaurant. Or 20% means you put $20,000 of your own money, $80,000 of your own money, and you borrow 20,000. Or you put 50,000 of your money, this is 50%, after 50% borrow, or you put $70,000 or $30,000 of your money and you borrow 70, or you put $10,000 of your money and borrow 90. Each one of these has advantages and disadvantages. Therefore, in this case, the first case, do you see it's written equity 100? That means that's your 100,000. You own all of the restaurant. In this case, we think restaurants as is valued as 100,000. However, when you use, equity, 80% is your money, and 20%, which is $20, is the debt. Here, $50 in front of equity. Do you see it's written 50? Therefore, as you see, you have the sales. Imagine that you sell restaurants. This is imagine that it is. You sell $100 in every case, for example. Now what will happen? You have expenses of 80, Therefore, earnings before tax, you deduct, your expenses from your sales. These are the $20 that come as, earning in your pocket. Therefore, interest expense in the first case, that is zero, because it was all $100 was your money, you don't pay any interest. But in the case of 20%, do you see interest of 6% of 20% is 1.2. That means you have to pay $1.20 to the bank. If you borrowed 50%, therefore 6% of 50% is 6 times 5 is 6 times 5 is 3, 50%. That is $3.30. The 70%, 6 times 6% of $70 is 4.2, and this is the last one. Therefore, your net income for these issues, in the first case, you had a net income of $20 because you didn't have any expenses related to the rent, to the payment to the bank. Therefore, you pocketed all the $20. If you have to pay taxes, then the taxes are 25%, means a quarter of this $20 goes as your, taxes. And now, in this case, you are making $15 in your net, earnings. And in the case of when you had borrowed more, do you remember? Do you see under 90%? You only make $10.95. And however, return on the equity. Let's look at your return on the equity. Means this $15 came on the money that you put, $100. On the $100 you had made 15%. Do you see that? You had made 15%. But on the case of when you borrowed $90, you had made 109.5%. Why? One second, the door on my door. 1 second, I will be right with you. 1 second. I'll be right with you. Okay. Sorry, I finished this video, and the reason I say is that we are helping people to file their taxes at the college. People come here and they knock on my door and said there are some people are waiting. We have 2 more slides, which I will call 2-3 more slides. I will cover, and what I will do is that I have created a discussion post that in here I will with my next video I will talk about this, and this is for now. Let's watch these videos and we will talk about this.